All right, if you're bearish in the markets right now, for whatever the reason, you're not going to like tonight's market outlook video. So I'm going to show you my routine and all the charts I look at to see if the stars are aligning for an extended and long-term bullish run. Tonight's trade idea takes advantage of a bullish posture that we have in a sector that is starting to show some improvement relative to its peers. And it's a combination of two trades into one. I'll show you what that is. Let's go ahead and get started. Today is Friday, June the 8th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, thanks for tuning in, everybody. I appreciate you watching tonight's Market Outlook. Welcome to those of you watching for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the Market Scholars logo in the bottom right corner of the video. Click the red subscribe button that pops out. Like today's video by clicking a thumbs up. Comment on anything that stands out to you. Join our daily Market Outlook email list. There's a link that's popping out in the top right corner of your screen. Click on that link and you'll be able to subscribe to our list. Follow me on Twitter for more content like this. Like and retweet tonight's Market Outlook tweet pinned at the top of my timeline. And then join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 with the market forecast indicator. And you can see that we had another rally today and up about, over 8 points. The intermediate posture is as strongly bullish as it can be, 98th percentile. You probably wouldn't have thought that back here, but remember, we've been bullish here for about a month now with the intermediate line rising above 50. And every time we get the blue line pulling back, it's pulling back to bullish near-term lows. And yeah, we had a little bit brief of a drop down below that 2-week average. I had said before here that the expectation is we break out of the 2-week average to the upside. We actually did on the Russell before. So the Russell didn't break down like the S&P did, and then eventually come back out. So a little bit of a false breakout there, which are the most, are very, very bearish to the downside. So, and especially without either the momentum line or the near-term line falling to like red flag levels, and the intermediate line remaining that whole time in the upper reversal zone, up above the 80th percentile. So we still have a bullish posture. That continues to be the case. The near-term line has been above 50 now for, let's see, 1, 2, 3, 4, 5, 6, 7, 8 days, up above the 80th percentile for 5 of those days. Coming up off of a low point between 20 and 50. Bullish signs all around on the market forecast. Shaded green here on the chart, so an indication that it remains bullish. The Dow Jones is picking up. Oh, one more thing on the S&P. It finally crossed above 50. We're up to 50.69, so we crossed above 50. Just to kind of give you an idea, the last time market sentiment crossed above 50 on the way up was back here in November of 2016, coming after the presidential election, and we had 4 intermediate rallies during that time. So here's 1, then here would be 2, then this would be the 3rd one. And then obviously 4. So 4 intermediate rallies, which when the market sentiment line crosses above 50, you typically get multiple intermediate rallies. Now, that's nothing's 100% in technical analysis, so we can, things can change overnight. But the expectations would be now with that orange line crossing up above 50 for multiple intermediate rallies, and again, we're in the first one. I don't think we'll get any of them like this again. We could. I don't think we'll get them as long because they typically last 1 to 3 months, 2 to 3 if market sentiment's as low as this. This was 4 plus. This was 5. I don't think we'll ever get. I don't think we'll not ever. But I don't think we'll get those on this go around. They'll look more like the one that we had here last spring, and then of course in the summertime. So they'll be more sporadic. But I do think that we're in the midst of, and you can even see the intermediate pullbacks that we had in between those. Were very, very small. This was the biggest intermediate pullback that we had coming off of that steep rally. And then, of course, this is a big time intermediate pullback that we had coming off of that very extended rally. Interesting to see how we had multiple clusters here at the beginning of that intermediate rally, but none at the end. Over here, we didn't get any at the beginning. We had multiple at the end. So, and remember, again, market sentiment was just starting to pick up back here. Over here, market sentiment was already pretty high. So you can see a little bit of a difference in these intermediate rallies. Here, this one, you got a couple markets, overbought clusters here in red, one at the beginning and one towards the end, and this one had one at the beginning too. So those clusters at the beginning kind of say, okay, now we're starting, we're getting going, and we just don't get one here because usually we're coming up off of a bullish clusters. Not too often you go from bullish to bearish immediately. Like that. You can, but it's not too often that you do. Right now we got a strong bullish posture. We're in the midst of the first. We're a month into the first intermediate rally, so we may still have another month or two left in this one. There will be near-term pullbacks here, so it's not going to be every day an up day, and the near-term line is not going to be above 50 for another month. So the blue line stays up above 50 7 to 12 days. In fact, you can see on the NASDAQ composite, the near-term line has already come back down below 50. So, here's this near-term rally here. So we're already starting to pull back. Not to a bearish level. The near-term line didn't fall in the reversal zone. The momentum line didn't fall to an extreme low. So we're not worried about any kind of trend change here. We're at the 96th percentile. But we're getting near-term pullbacks, and we will get more near-term pullbacks, and they may be light, they may be steeper, but they'll typically be bullish. While we maintain this month to 2 months, potentially maintain another month or two on the current intermediate rally. And then at some point, the intermediate line will pull back below 50, and we'll look for the beginnings of a new intermediate run. And again, go back on the S&P 500, just a reminder on these other, here we go, on these other intermediate rallies, here we go. And let's go back to a 2-year chart. So back in here, if I were to zoom in on this and draw the Fibonacci lines nope, not that one, here at the beginning, and here, let me just make sure that we snap to open, high, low, and closes. So I'm going to come over here. That's up to the beginning. This is to the end of the intermediate rally. And let's throw on that 23% Fibonacci retracement as well. Line. And now zoom back out. So you can see the pullback on that intermediate pullback got us to the 23% Fibonacci level. So that was the first one. Now let's get rid of that. So let's remove that drawing. There we go. Remove that drawing, and let's zoom in on the second intermediate rally. So that would be this one with that pullback right there. So here, let's do this. Let me get rid of I think it'd be this one here. That's what's scrunching our, there we go. So here's the intermediate rally. Zoom back out again. It's right here from this low to that low right there. So it'd be like right in that area. So the Fibonacci lines would be from here up to this high point, because there's the pullback, and you can see this one got to the 38% Fibonacci retracement. Okay, so we'll remove that drawing, and then zoom in again. We'll go from this small one, it ended up being about a month. So we'll draw our Fibonacci retracements on that. The rally started really right there and ended up peaking up there, and it pulled back a little bit further than the 78% Fibonacci retracement. Kind of got down there on a closing basis, but that was a deeper pullback than we've had on that intermediate rally. And then, of course, on the big one here, the one, this really rare, oops, right there, we'll draw that one there, all the way up to the high point. So we pulled back to the 62% Fibonacci retracement a couple of times before bouncing. This was a market sentiment pullback. So you can kind of see how, this intermediate line will go up. Let's get it back to normal here. The intermediate line will go up for another month or two. It will drop back down below 50. It will not be the end of the world, though it may seem like it. It will not be the end of the world, because again, remember, we're expecting multiple intermediate rallies. So if it does pull back below 50, we'll watch to see how far it pulls back using Fibonacci retracement. bringing that intermediate line below 50, and then we'll look for the bounce and the beginnings of a new intermediate rally that would last another month to 3 months, just like normal. And that's how market sentiment runs. The long-term runs. That's how they perform. There are multiple of these intermediate rallies where the intermediate line goes up above 50, comes back down, goes back up above 50, and comes back down, while the market sentiment line stays the whole time in the upper half of the chart. A quick reminder before we look at these other charts, for those that are watching here, the Market Outlook on this blog, you can like the Market Outlook tweet and the Facebook post here on the same page. And again, there's benefits to doing that. The algorithms these social media channels have, by interacting with these pieces of content, that tells them you want them to send you our stuff when we post it, because they won't send you all the stuff that you follow because there's just a lot. So the more you interact with our stuff, the more you're telling Twitter and Facebook to keep sending you. It also tells us that you like it, that you like this material, that you want us to keep doing it. Of course, there's the green button here to like it on the blog. And then also, it tells everybody else that they should follow it too, because then Facebook and Twitter will start showing these tweets and posts to everybody who follows our accounts to make sure that they're getting these engaging pieces of content as well. All right, when you look at the long-term chart, you can see we are above the rising 15 200-day moving averages. The 50 is above the 200. They're both rising. So, I mean, that's all, and this line's rising here. So all of that is all bullish. Can't be more bullish on the market forecast chart. It can't be more bullish here. And then if you look at the 3 green arrow charts, you can see we got 3 green arrows. So we're shaded green across the board. We're above a rising moving average. MACD is positive. The stochastics is just like the intermediate line, at extreme levels. You can see the MACD and stochastics are both above their moving averages. We're above a rising 8-day moving average. So lots of bullish signs, across the board here for the S&P 500. Then you add on the fact that we're trading in the upper half of the 4-week range, right at the 4-week high point, and not pushing up through it. You can see the high of the 4-week range is yesterday, but we're trading right at the 4-week high, at the high of the day, at the high of the week. Higher high and higher low for the week, with the low right early at the beginning of the week. We didn't get a higher high and a higher low today. We stayed within the range of yesterday, so a little neutral from that regard, but still pretty bullish from that perspective. You can see the ATR, the relative ATR, is now entrenched below that 1% level. That's a positive sign. You can see, when you're bullish, you get and stay below 1% for quite a while. So that's a very, very good sign. I mentioned before back here, when the last time we had market sentiment below 50, that was the last time that ATR was above 1%. And now you can see when it got below, it stayed below for a while. And same thing that we're getting, potentially here. Again, whether we're going to get a 4-month and a 5-month intermediate rally, I highly doubt that on this current market sentiment run. But you can see volume is trending lower. ATR is trended lower. Very, very good sign from a market perspective, from a bullish market perspective. And then add on to that the VIX being, now coming down and being below the 90 to 95th percentile, which is the neutral range, trading in this bullish area around the 85th percentile. So everything we look at here, and we look at the same things for a reason, day after day after day, everything we looked at confirms this bullish trend. And again, it's not like we just turned bullish today. We've been bullish on these videos for multiple weeks here, but you can kind of see now everything adding up and confirming and pointing towards extended bullishness going forward. Now it might not be as pretty as 2017. We might not have a year as pretty as 2017 for years. That was very anomalous in terms of how historically low volatility was. We could very well get more volatility this year in shorter and more frequent intermediate rallies, but at the very least, we are looking at multiple intermediate rallies going forward from today. So to summarize, the long-term chart's bullish, it's shaded green. The market forecast and the 3 green arrow charts are both shaded green. We are trading in the upper half of the 4-week range, and volatility is in the bullish zone itself. So, and ATR and volatility are both in their bullish zones. So put all of that together, and it's kind of hard to come up with any reason that we should be bearish. So what do you think? What's your take, and do you agree or disagree? There's a poll that's popping out in the top right corner. Let me know if you agree or disagree with this take, and if you see something else that we're not looking at here that does or should tell us that we should be more bearish than we are. Let me know in the comment section below. All right, so we take a look at now what's driving the price action today. So transition a little bit, and we see here, just looking at today, or this is the last 4 weeks actually. This is over here looking at today. You can see Mexico and Brazil, the outperformers in consumer staples. I mean, these areas have been the most beaten up areas that we've seen, and they're really taken off. Retail doing well today. On the other end of the spectrum, Russia doing poorly. Semiconductors, crude oil, some of these have been relative performers in the past. So you can see this is a 4-week view, and all coming from the beginning. Here's the zero level over here. You can see all the indexes that are above and still rising above that zero line are U.S. stocks, small cap stocks at the very top, up 4.62%. And you can see the S&P is close to 3%, up about 2.5%. And below that is preferred stocks, and you can see the dollar, which had been an outperformer up to this point, has been pulling back, as well as bonds. Long-term bonds also had been gaining at that time. It's been plus. Stocks have rallied. Both of those safe haven asset classes have pulled back. High yield has been a relative performer. It behaves similar to stocks, has not outpaced bonds, government bonds over this time. It's been a small loss, but you can see it's held its ground when bonds have been pulling back. So from over the last 2 weeks, really. In fact, I can zoom in on the 2-week chart here. So here's the 2-week chart, and you can see now long-term bonds have been pulling back, and high yield, holding up its value. So that's similar to a risk-on pattern when you see that. Down in here, you got a bunch of foreign things, with crude oil being the worst performer over the 4-week period. Look, it's down 7%, and not surprising that emerging markets have been a laggard as well. The one I have my cursor on, it's been down. You can see here commodity prices also pulling back. Interestingly enough, pulling back with the dollar, so that's not typical. You can see gold. Here's the price of gold, also lagging behind stocks and bonds during this 4-week period. Again, not surprising that it's down because it's a risk-on move. But all of these commodities, the agricultural commodities, crude oil, gold, if you want to lump it in with those, they're all lagging behind with. There's your developed foreign stocks that's down for the 4-week period too. It's all U.S. right now, and it's not just all U.S. It's especially all U.S. in equities, bonds, the currencies itself, and really both bond asset classes. Anything international or commodity based lagging behind, and we know things change and rotate, but that's kind of where we're at right now, and they're still kind of pointed upwards. Now, if I just look at this past week, so the last 5 days, and we'll look at a smaller time frame here, look at a 10-minute chart. So here's over the past week here. So this would be last Friday, and then Monday, Tuesday, Wednesday, Thursday, and today. So this would include last Friday. So really 6 days. You can see that the S&P and the small caps are both rising, along with preferred stocks. You can see international stocks are up a little bit too. Gold up being a little bit, with the dollar down over this week. And then you can see crude oil started the week down, along with ags, and then crude oil rallied. It still finished down. Long-term bonds also underperforming on this safety move, and gold rallying simply because of the weakness in the dollar. Gold rallying there. So high yield outpacing long-term bonds this week. Gold outpacing crude oil, which is not risk on, but it's, that's, again, we know why, because of the weakness in the dollar. Dollar had been strong, it's been weak. You can see foreign bonds here lagging as well. So it's been the week here in the economic calendar. The economic surprise index is lower. It's still positive. It's not negative like the rest of the world, especially in Europe. So it is positive. It's lower than it has been. You can see the economic calendar we've had this week with trade earlier this week and factory orders and ISM. The GDP estimates were updated today. They'll be updated next Thursday, but they were updated today and still maintaining relatively high estimates at 4.6% for the second quarter. If I take a look at what's coming up on the calendar here next week, there's a lot of red dots, which means significant news for the markets, especially the Fed. They're expected to raise rates here next week. As we all know, that the expectations are close to 100%. They're down a little bit, but still close to 100%. So we're going to get a rate hike, most likely. Here we go. Next week, we'll also get the forecast and the press conference that comes with it. So that will be in the news. You can see the CPI and PPI inflation data are coming out. So it'll be interesting to see how much commodities continue to underperform when you have inflation rising, at least have been rising. So we'll see if that continues, and economic growth and growing. So those are two things that typically are bullish for commodity prices. So that will be a big factor next week, in addition to the basket of indicators: industrial production, Empire State Manufacturing, retail sales, import and export prices, inventory data. All these things will be coming out on Thursday and Friday, as well as the summit, the U.S.-North Korea summit that's expected to be on the 12th too. So it's a busy week next week. There's a lot going on. There's potential for volatility with all the news that's going on. So we'll just keep our eyes out for that, knowing that this current market that we're in right now is is bullish, and the near-term rally is bullish too. So we can get a near-term pullback with any volatility next week and just be fine with that, and set up for a new near-term rally, potentially up to a new near-term, coming off a higher near-term low up to potentially a new higher near-term high. So if we do get any sort of volatility next week, we would expect that it wouldn't be trend changing. It would just be more of the pullback nature. Interesting to see the sectors and how they're performing: real estate, technology, consumer discretionary. Even though technology pulling back a little bit more here, because remember the Nasdaq was the weakest market forecast chart, only on the short term, right? And healthcare. Those are all of your sectors that have rising moving averages, where we're above a rising moving average, and we have strong bullish postures. Now, two of them are falling, but they're still well above 80, so nothing too concerning there. Those are your strongest sectors. Materials getting added to that list now, with it being above a rising moving average and also above 90. You can see industrials is above 80, so it's bullish, and financials here up above 66. So these are the areas that have been lagging behind, and of course staples finally breaking out a little bit, getting up above the 50th percentile on the intermediate line. Positive sign for that bullishness, and you can see now getting above a rising moving average. That's why you see it green. So things are starting to look better for that really embattled sector. These other safe haven sectors, except for utilities. Utilities is now the big loser, right? Staples have been the big loser. Now it's utilities, down below a falling moving average with a really bearish posture. So the safety trade right now is switching from what was bullish here over here into the staples area, and real estate continuing to be positive. So positive sign. Economics from real estates and industrials and materials. Those are elements of the economy that reflect, they're economically growth sensitive areas, interest rate sensitive too on the real estate side, but economic growth sensitive areas, and they're all starting to catch up to these other previously strong areas, and real energy, which had been the strongest, lagging behind a little bit. But again, I wouldn't expect it to lag behind for too long, if inflation continues to show bullish signs going forward, and economic growth continues to show bullish signs going forward, because energy is needed to fuel that economic growth here and abroad, but at least here. And if it continues to be here, do you expect the global economic environment to improve as well? So for today's trade idea, I want to take a look at CSX in the industrials area. You can see how bullish it is, breaking out back here and pulling back to old resistance and then bouncing back up and now being as bullish as we have been, with the market being bullish this month and really taking off here up to new 52-week highs. Again today, kind of a breakout move, strong bullish posture, bullish across the board. When you look at the 3 green arrows for this chart, go to CSX here, CSX. And you can see a moving average crossing, the MACD crossing above its moving average. Stochastics also crossing above its moving average and getting up above, back up above 75 here over the last couple of days. You can see down here at the bottom, the volume is a little bit above average, not quite 1.5 times, but a little bit above average on this little bit of a bounce up to 3 new green arrows here. New set of 3 green arrows, with the MACD coming today, stochastics yesterday, and then the moving average has been green this whole time. So good bullish chart from that perspective. You look at some of these others like the Bollinger Bands, and you can see breaking up above the upper Bollinger Band with a relatively really low Bollinger Band width, and then finally you look at the DMI in terms of how bullish we are. That DI plus has been above 25 this whole time, which is a very good sign from a bullish perspective. You can see it cross above 25 back there. So a good sign for the DI plus when it crosses above 25, and you can see the minus is moving away from it. Pretty decently strong ADX, which is the gap between here. So we're on a good, strong trend. So things are looking pretty positive. Of course, we talked about the potential for near-term pullbacks, especially considering how long we've been in. So, we can say, let's take a look at a bullish trade really quickly on this. And if I were to sell the 62.5 and 65 here, let's delete all these. Sell the 65 and buy the 62.5. I can get a pretty decent credit for a $2.50 wide spread. That's a 30% return. That 65 area is right there, so it's kind of would nullify this breakout. Of course, there's a good chance we can hit 65 if I were to analyze this trade. And let's get rid of these here really quick. Analyze this trade and put this to July 20th, July 21st, even really just by the end of the month. Let's take a look by the end of this month over the next 3 weeks. Set this slice here to our short strike price, and let's change the probability mode to in the money. You can see between now and the end of the month, there's a pretty good chance that we'll come back and pull back and touch 65. Even though we're bullish, there's a pretty good chance that we will touch that. So in the meantime, what we can do is we can say, okay, well, by the end of the month, which is still 3 weeks away, we can do a calendar spread at that strike, at that $65 strike, with the long strike here in January 20th. You can see it's a little bit more expensive than the credit I get from that short spread. But if I analyze that now, you can see, okay, if we do pull back by the end of the month and touch that 65, let's say if it does that in the next week, then I'll make, instead of being worried about my bull put spread, I'll actually make $17 per contract on this account, or on this trade, on this calendar spread. And if it does it, let's say it keeps going up for a while and then pulls back in 2 weeks, I'll make $30. Which is about half of the credit. That we can say, okay, well then once I close out that calendar spread, you can see by rolling the June 29th to a July 20th, I'll basically turn it, I'll turn that 65 strike into this short strike. So I'll end up with, after I roll this calendar, I'll end up with that vertical spread. But now, instead of just getting a 60-cent credit, I'll be able to add the return during that pullback. I'll be able to add whatever return I get from the calendar spread to that credit. And so what is that trade? That trade, the combination of that trade is this one. Selling the 65 strike in June 29th and buying the 60 strike over here. It is a this would be a what is called a calendar diagonal spread. Again, with the idea that if I roll this strike here, if I roll the 65 call from June to July, once I roll that call, then now I'll end up with a short 65 in July and keep the long 60, or excuse me, it would be 62 and a half, sorry. The long 62 and a half in July. So I'll keep that one, and then I'll end up with this switching from a short 65 put in June 29th, I'll end up with the short July 20th 65 put. So again, this spread down here, this one trade, is essentially these two trades put together. That, the calendar is first, and once I roll the calendar, I'll end up with the vertical spread. And there's what I'm getting in the vertical spread. So whatever I make or lose on the calendar, I'll add or subtract from the credit of that vertical spread. And so this is the trade right here. We'll get rid of this one too. So this is the trade. This is a bullish vertical spread, 65, 62 and a half, like you would normally do. But in case of a pullback to 65 between now and expiration, again, simply because we're bullish, and this is really bullish, but in case of a pullback between now and the end of the month, then I will make money on that pullback on this calendar. And then once I roll the calendar, once I roll this 65, then it will turn the trade into the vertical spread for July 20th, and that's when I will end the trade. So it's almost two trades. I have to do something before June 29th, and then I still have to do something by July 20th. So two different trades, two different things I have to do with this. First the calendar, then the vertical spread. The vertical spread's high probability, so essentially this is a way to do a high probability calendar spread, if you look at it in one way. Another way is it's a way for you to do a more profitable, potentially, a more profitable vertical spread. Because like I showed you, it's a high probability vertical spread as it is, but there's a high chance that we'll pull back and touch the 65 strike between now and expiration. So if it does, I'll just add to my return with what I make on that calendar spread. So if you have any questions or comments on today's trade idea or today's market posture, there's a link that's popping out in the top right corner of your screen. Let's talk about it in the Market Outlook forums on marketscholars.com. Make sure if you add any post there and you want me to see it, make sure you tag me in that post at SettleDA, and that way I get notified when you put a post in there. And again, to participate, you have to subscribe. So go to the top right corner, and there's a link up in this video too. There's a link that will subscribe you, that you can go to subscribe to our site. So make sure you do that. But love to chat with you, hear your thoughts. What did you get out of tonight's video? All those things you can post in our Market Outlook forum. So have a great weekend, everybody. Thanks again for watching. We really, really appreciate you watching. Remember to subscribe to our YouTube channel, like today's video by clicking the thumbs up, and comment on anything that stands out to you. Follow me on Twitter for more content like this. Join our Market Outlook Facebook group, as well as subscribe to our site. Have a great one again, and we'll see you all next time.